One thing that's extremely satisfying for me is when I see that people that were so bullish on the housing market for so long finally starting to reverse their tune on things. And most notably, the people we're talking about here are Mark Zandi from Moody's Analytics, as well as Kelman, who's the CEO of Redfin. These two guys for the past couple of years have been saying that the housing market's going to go nowhere but up and home prices are never going to go down, guys. Well, now they're finally admitting that home prices are going to go down in 2024. And it's about damn time. And I want to read you some of the things that these guys are saying, because for the longest time, which I've covered in numerous occasions on the channel, these guys were just talking about how, oh no, we're going to see home prices go up again next year, home prices go up again next year. You know, there's going to be no distress in the housing market. And we're starting to see that that is not actually true. Now, before we get into that, I just want to say, are we seeing the level of distress so far that we've seen in the 2008 housing market crash? No, we're not. But that doesn't mean that we can't get there over the next few years if things get progressively worse. I just want to put that out there. So here's the first thing that Mark Zandi says, okay? The only way out of the box, the only way to get sales back up is mortgage rates have to come down, incomes have to continue to improve, we have to avoid a recession, and I expect we'll see home price declines at some point here. Finally, this guy is saying this, because before he would never say anything like that, and now he's changing his tune. So it's good to see that finally some people are starting to wake up. But if you ask me, it's too little too late, you know? You can't just say that home prices are gonna go up for the past 3 years and now all of a sudden say that things might be changing in the future, guys, because it makes you look stupid if you ask me. But regardless, he's pretty much outlining the Goldilocks scenario that would need to happen in order for us to see no home price declines, like no recession, incomes going up, mortgage rates coming down. Like, yeah, right, guys. You think all those things are going to happen, especially in tandem? It's not. So that's going to be the biggest problem with this. And a lot of people are already starting to see signs of distress in their local markets. Now, Kelman, he was recently interviewed on Fox News, and they asked him about Morgan Stanley's latest forecast of a 3% drop in home prices in 2024. And he said, it seems that it's not just possible, but likely. Before, he was another one saying, oh no, you know, we're just going to continue seeing home prices going up, guys. And I've been telling you here on the channel that that is not sustainable. That is not a situation that we can continue to see forever. It's just not possible unless we have literally perfect economic conditions with relatively low inflation, massive wage increases year over year, low unemployment, and all these things that can contribute to a massively booming economy. Then maybe it can continue indefinitely, but that's not what we are seeing. Even Mark Zandi is saying, oh look, the home sales are at the lowest levels we've seen in 13 years, which dates all the way back to the previous housing crisis. So the housing market's getting crushed right now in terms of being able to sell properties and people making money with this. And he thinks there's going to be no immediate relief on the horizon. He says, I don't expect the housing market to come roaring back in 2024. Probably won't be until 2025 or 2026 before we see sales levels that are more consistent with what we've enjoyed historically. Now, I think that's actually probably true. I've disagreed with almost everything this guy has ever said, but I do think he's right about that. I think that by the time we hit 25 or 2026, that's when we're going to start seeing the sales pick up. And the reason we're going to see the sales pick up is because housing will become more affordable. So as we see home prices go down, more people will buy. And so that's the funny thing about real estate, right? It leads to this dynamic where prices go down for a while, and that leads to sales surging, which eventually leads to prices going back up because the demand keeps going higher and higher as more people want to buy, and eventually it will lead to prices going back up in the future, guys. But these cycles take very long to complete, and we're only just now going down the roller coaster side of home prices coming down. And Kelman's all optimistic about the housing market in 2024 because he says, oh look, how inventory's already going up. Like, well, yeah, that's because people aren't buying houses, dude. Inventory is going up at a time of year when it always goes down. You don't think that's a red flag? You don't think that's something to look at? He even says himself that More people are listing homes right now, and many owners who failed to sell their homes this summer are relisting them at lower prices. The market has just been frozen because buyers and sellers cannot agree on a price. For the first time, there's a break in the logjam where we might see a real drop in prices, and that's going to spur sales. Like, he even just said it himself, guys, that people who are relisting their homes that couldn't sell in the summer for lower prices because people need to sell now. It's getting to the point where people can't wait anymore. The cost of living, inflation, life is getting too expensive in general, and people that used to be able to afford their home no longer can, as their budget is getting squeezed from all different angles. And as more and more people fall into this position, you're going to see more listings hit the market, but the problem is the buyers are not there to absorb it because the prices and interest rates are still way too high. So once again, what's going to happen first? You're going to see this magical situation where inflation keeps going down and wages keep going up and the economy's booming and interest rates come down and everybody just jumps back into the market? No, guys. We're already starting to see the cracks form where prices are coming down in order to make houses sell. And going back to this Morgan Stanley prediction, let's talk about that for a minute. Morgan Stanley's chief economist, Ellen Zentner, she says that we expect home sales to be weak in the first half of next year, but activity should pick up in the second half and further into 2025, and that's because affordability will improve. So that's what's going to cause more home sales going up, guys, is when prices come down substantially enough where people can afford it. Now, I actually don't think that we're going to see prices come down substantially into 2024, at least in a lot of areas yet, to make it so that home sales do go higher. You might see this in some pockets across the country, but I don't think it's going to be the norm, at least until 2025. And I'm saying that now to be on the side of caution, because this housing market crash is taking longer than I expected it to, because everything seemed to happen so fast during the pandemic that it kind of set this expectation that things are always going to be like that. But that's not how it's going to be. Zentner also goes on to say we're going to see an increasing supply of homes for sale next year. We're already seeing inventory rise at a time of year on the resale market when it normally is going down. Combine that with the fact that we have a ton of new construction happening as well. Morgan Stanley is saying that they think new construction is going to be the main source of new supply coming on the market in 2024, which is going to be probably the lion's share of it. But if we go further and further into hard economic times, you're going to see the listing count continue to go up and those listings stagnate on the market as sellers are not in tune with what prices should be today. Because I still see way too many listings of people listing homes for sale as if it's still July of 2021, guys. I mean, those days are over of being able to ask these crazy prices and people are just going to pay it without even giving it a second thought. It's not happening anymore. Zentner from Morgan Stanley goes on to say that home prices should see modest declines as growth in inventory offsets the increases in demand. By 2025, with lower rates, existing home sales should rise more convincingly. Once again, going back to the notion, like I've been telling people, that the reason we're going to see home sales go up is because prices are coming down. That's the only thing that's going to drive home sales back to where it was before. She also thinks that the Fed's going to start cutting interest rates next year. They're going to do at least a couple of different 25 basis points rate cuts next year, and that's going to also lead to mortgage rates coming down. Like, the funny thing is, there's still a mention of a soft landing in this story, which is not going to happen, guys. Everybody needs to understand that the whole reason that the Fed is dropping interest rates is because there's not going to be a soft landing. They're dropping rates because things are tough and the economy is starting to show cracks and starting to fall apart, and that's why they're dropping rates. But nobody wants to look at that because it's even mentioned here in this same story. The bad news, according to Zentner from Morgan Stanley, is that a slowdown in consumer spending driven by a cooling labor market weighs on real disposable income. Higher for longer rates will also put further pressure on debt servicing costs for customers. Meanwhile, GDP growth is projected to slow from 2.5% to 1.6% in 2024 and 1.4% in 2025. Even let's say that those GDP projections are correct, guys. That means that for the next 2 years, we're going to see our GDP continually going down because of these higher for longer rates. Do you think that that cannot turn into a massive recession? Because it can. The official definition of a recession, which was basically debunked last year when they said there was no recession, is 2 quarters of negative GDP growth, okay? And so if we're only looking at 1.5% growth on average over the next couple of years, do you think that's going to be enough to actually make things continue to go well? Fair warning, even Redfin is hiding listing data now, especially when it comes to rentals. You can't see anything about what this house was purchased for or how much it was asking for rent in the past, anything like that. It just shows the rental listing. So now Zillow and Redfin are both hiding listing data. Good thing I have the trusty old MLS and why you might need a realtor, folks. But anyways, this house is 4 bedrooms, 3 bathrooms, and is listed at $7,500 per month for rent. They started off asking $8,500 per month, and it's been listed for 2.5 months, no takers. And they just bought it back in 2022 for $1,725,000. And get this, during the last housing crash, somebody paid $291,000 for it. Okay, so that just goes to show you how ridiculous this is. Property tax bill here is a whopping $25,500 per year. So this is looking like overall it's a pretty bad time to be a landlord, especially when you grossly overpay for real estate. I think what it does is it puts the U.S. economy one step away from disaster, one hiccup away from going into a deep recession, just like consumers who are living paycheck to paycheck and, have a ton of credit card debt, guys. As soon as one thing goes wrong and they can't borrow any more money and they can't pay an expense, they lose their home, they're on the street, they lose their car. Something major happens to people like that under those circumstances, and the same thing's going to happen to the U.S. because we're living paycheck to paycheck right now. We're living worse than paycheck to paycheck. We're living so far beyond our means, it's not even funny. And if we only have a 1.5% GDP projection, that's pretty bleak. And all it takes is one little thing that can tweak that into a negative projection. Another source of inventory we're going to see, and we're already seeing right now and have been seeing, let's be realistic, is remote workers who are selling homes to go back to the office, guys. We've talked about this a bunch of times, but there's some new data on this because in September, Redfin reported that about 10% of home sellers in the US are looking to move because of return to work policies. So that is a lot, 10%, okay? So let's see, there's like a little over 1 million homes for sale on the market right now throughout the country. That means about 100,000 of those people need to move due to going back to the office. That is not a little bit. That's a lot of people that are being forced to move right now. And some of these companies are really cracking down, like Google said that they are going to consider office attendance records for performance reviews. So now people's livelihoods are kind of on the line with the return to the office thing, because if people don't go back, then they might get skipped over for promotions or getting raises or be the first to let go for the next round of layoffs. I think you're going to see inventory coming from a lot of different places as things progressively get worse in the economy, as more layoffs happen, as more companies require people to be back in the office, as more people can no longer afford their house payment, guys. You're going to see people forced to sell, unfortunately. That's just where things are headed right now. Why else do you think inventory is going up in November when we normally see it plummet, okay? It's because people need to sell these houses. And it's funny because it's always too little too late with the government and all these things, right? Recently, the National Association of Realtors is pushing for a tax credit for home sellers. They're actually the biggest lobbying group of the United States government, is the National Association of Realtors. And they're saying that the US lacks too much inventory and that we need to give home sellers a tax credit to put their home on the market for sale. Lawrence Yun, he's the chief economist at NAR. He says we need to talk to members of Congress to see if we can have some kind of tax credit for home sellers to list their property onto the market. homeowners in the US aren't putting their properties up for sale because they're locked into their low interest rates. Well, I even covered the other day how people are starting to give up those low interest rates because they just need to move, guys, because life goes on. So it's not like everybody's going to hang on to these rates forever, first of all. He's saying that this is helping to perpetuate a housing shortage, and that's where we're having problems right now with real estate. But if they just let the market do its own thing and they let things rebalance on their own, we're not going to need any sort of tax credit. The market will handle itself, guys. And the funny thing is, if they are convinced to do some sort of tax credit for home sellers, you could see a deluge of homes go for sale on the market, and that will ultimately be what likely crashes the housing market if something like that were to happen. But they say that the proposed tax credit would be temporary and aims to encourage long-tenured owners of single-family homes to sell their home to an owner-occupant. They estimate this could bring about 640,000 new homes to the market. So that's substantial, guys. That's more than half the inventory we even have right now. So imagine inventory shot up by 50% on the US housing market. That's back to pre-pandemic levels, basically. Throw in all the foreclosures we're starting to see happen. Those are going to come to the market eventually. All the new construction being built. We could easily be in a situation in the next 3 to 4 years from now where inventory is even higher than it was pre-pandemic. We don't have to look any further than the car market to see a preview of this, right? Like, you guys know, the car market is completely busted right now. It's completely upside down. And check this out, guys. Just when you go to Jeep's website, okay, they're having this big Black Friday event. Look at this. Select remaining 2023 Jeep brand vehicles. Get up to 15% below MSRP. Well, just a couple years ago, they were charging you 15% above MSRP, and people were paying it. Now, they can't get rid of these cars, and they're being forced to discount them pretty heavily. You got Black Friday deals for cars now. Imagine that. Now, of course, you're not going to be able to pick the cream of the crop models with these sort of sales. You're going to have to take whatever they have left in order to get these prices. But still, guys, be able to buy a brand new car for 15% off of MSRP, that's a pretty good deal. Or how about this one? This is because interest rates are too high. All 2023 and 2024 Chrysler, Dodge, Jeep, and Ram brand vehicles, no monthly payments for 90 days when financed through Chrysler Capital. Why are they doing this? Because people are broke and they need to sell these cars because they have too many of them. So, like I said, this is a preview of what we can see in the housing market over the next few years, because this is what happens when you have too many cars for sale and not enough people out there buying them. And this is exactly where I think we're going to end up when it comes to homes for sale on the US housing market. The problem is it's going to take longer because things need time to play out, guys. People live in houses. People don't live in cars. They can make cars a lot faster than they can build new houses for a lot of different reasons. So the car market moves a lot faster than the housing market does. Therefore, we're already seeing this whole thing go down. So it could be a few more years before we start seeing inventory at levels where it's suppressing and crushing prices. And if none of the rest of it does it, the recession will. Because check this out. There was a news story today about how recession worries are re-emerging as high interest rates sap the US economy. Because for a long time they were saying, we're not going to have a recession, we're going to have this soft landing. And now more and more economists are starting to rethink this idea and actually look at this and say, you know what, we might actually have a recession, or we might actually even be in a recession now. Who would have thought? Just over half of the Wall Street economists who were polled by Bloomberg now think that a downturn is likely next year, meaning in 2024. Just a few months ago, it was a minority view. So now you're talking half of them think that next year we're going to have a recession all of a sudden. Why is that? One of them says that I think the economy is slowing down. The only uncertainty is whether it's going to be a mild recession or a deep recession. That is the only unknown today. Even economists that think there's going to be no recession still have drastically reduced their outlook for future growth, meaning that we're going to have a prolonged period of below trend growth, just like we were talking about earlier about the Morgan Stanley GDP projections, guys. 1.5% growth over the next couple of years is abysmal, okay? And it only takes one hiccup for that to go in reverse. And here's the problem. Because the high interest rates have a delayed effect on the economy, it looked like for a while that nothing was going to happen because we haven't seen massive unemployment. We haven't seen major cracks happening until recently, because now the high interest rates are starting to do their job. What it's doing, curbing the demand for new cars, like we just talked about, home furniture, and other big ticket items. And it's also making it more expensive for businesses to borrow and invest. And obviously the less that businesses do that, the less hiring that goes on, and the less the economy grows. The economists over at BMO Capital, they say that consumer spending and business investment are the two biggest legs of the economy. If they start to wobble, the economy will too. What have we been saying here on the channel for a while now, guys? I'm not even an economist. I'm just a guy here on YouTube, and I think I got it figured out. So it's not really that hard, you know, it's not rocket science. You know, they make all these terms up and all these crazy numbers to make it all sound more complicated than it really is. At the end of the day, if people aren't spending money, and if people aren't making enough money to continue spending in this economy, things are going to come down. It's pretty much that simple. So what do we have to look out for, they say? Well, we got to look out for rising unemployment, which is something we've actually been seeing happening recently, not by much, but it is happening, and reduce consumer spending, because the more that happens, then the more businesses will lay people off, which will contribute to higher unemployment, and the higher unemployment we have, that will lead to less consumer spending. It's a vicious cycle, because if people don't have a job, they're not spending money. Makes sense, right? Just in 3 months, the unemployment rate went from 3.5% to 3.9%, and layoffs are creeping higher and higher, and people are not able to find a job as quickly as they were a year ago. But they're saying, don't worry, the labor market's still very strong, and it's still going to take a lot more of a downturn from here to turn this into a recession. Well, it seems like we're well on our way. They also say we got to look at what's the Fed going to do, because the higher that these interest rates stay high for longer, then the more damage this is going to do, and the more financial pressure it's going to put on the overall economy, which is going to lead to even slower growth and more layoffs and less spending, guys. And that's what these high rates are designed to do, and it's finally starting to work. And they say, wait a minute, we can't declare victory and say that we're not going to have a recession, because prices jumped 18% in the last 3 years, the CPI shows, and that increased faster than incomes. And people are now feeling that big time, and the strain on the rising cost of living are increasingly becoming evident, because delinquencies on auto loans and credit cards are still relatively low, but are on the rise. So this is something that we need to look at. And they go on to say that delinquencies are basically a forward-looking measure, and it kind of gives you a preview of where things are going, guys. And if delinquencies are on the rise, how is that a good sign? How is that a good omen for the future of the economy? It isn't. So if I were you, I'd be very careful if you hear people say right now that there's not going to be a recession, and that as soon as interest rates come down, that everything's going to explode and the economy is going to go bonkers and things are going to go back up again, guys, because that is not the path that we are on. And even big economists now are starting to change their tune on this. So be vigilant, pay attention. So if you guys enjoyed this video, make sure you subscribe to the channel, and if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.